Hello, this is Tim Congdon, a chairman of the Institute of International Monetary Research at the University of Buckingham. This presentation is being given at the end of November 2020. It's another one of the series the Institute does on monetary trends around the world. But today I want to focus on Britain in particular. At the moment, in my view, the level of government bond yields is like something out of Alice-in-Wonderland. We have negative yields on index-linked, inflation-proofed government bonds, and in my view this is creating an extraordinary situation which I want to discuss at a bit more length. Now I'm going to start off just by a quick survey of the current situation. Then I'm going to spend quite a lot of time on what I call the looting of the rentier in post-war Britain, really in the 30 years up to the mid-1970s. And then I'll bring us up to the present day with the government's response to the COVID-19 pandemic and the large increase in the budget deficit and the public debt that we're currently seeing and the implications of that for the future. Now here is the chart on the growth rate of the quantity of money in the last 10 or 15 years. And you can see that after a period of stability in the 2010s, there has been a sharp acceleration in money growth in 2020, not as pronounced as in the United States. The annual rate of growth is in double digits, and in the spring there was a kind of hump when the initial official response to the pandemic led to a surge of money growth. We had the lockdown in the spring. A second lockdown is now in effect. And the Bank of England has reacted to that by announcing a second instalment of quantitative easing with asset purchases of about £150 billion. That to take effect in November, and I suppose to some extent in December. And now, in my view, this second instalment of QE is a serious mistake. There is at the moment no great sign of financial strain in the UK. House prices are rising, the stock market's relatively buoyant, and so on. With this £150 billion of asset purchases, money stock is currently about £2,500 billion. You're going to get a one-off upward blip to the quantity of money of around about, maybe not exactly 6%, but call it 4 or 5%. So when we look at, this is a projection I'm giving you now, when we look at the growth rate of money, say 6 months from now, we'll see a second hump for the second instalment of QE. The annual rate of growth of the quantity of money will move up probably to 15%, possibly a bit above 15%. Now in the long run, there's a relationship between the rate of growth of money and the rate of growth of normal GDP. It seems to me very likely that inflation will exceed 5% at some point in the next 2 or 3 years as a consequence of this burst of, in my view, unnecessarily high monetary growth. Yes, there is the crisis, but there is a vaccine, well, a number of vaccines in prospect, and life will return to normal, and there'll still be this overhang of excessive money balances. Now, the return of inflation is something, I may be wrong about that, but I don't think so. I've got many things right in the last 30, 40 years, and that's something I'm pretty confident about. The return of inflation is a disappointment because in the last 30 or so years, one of the achievements of British public policy is to have banished inflation, to have brought inflation under control. And what I want to do in the next 7-8 minutes is to run through a scandalous period of 30 years in which holders of UK government bonds were cheated, looted in an appalling fashion. Here we have the chart of the yield on the console bond, 2.5% consoles. They started in 1753 when the public debt was consolidated by the then Chancellor of the Exchequer, a chap called Pelham. So we have, they've now been redeemed, but we have over 250 years continuous history of this government bond yield. In the first 200 or so years, Britain was on the gold standard, or from 1931, suffering occasionally from deflation. So you had this long period of expectations of long-run price stability, and the typical yield on these consoles was about 3%. Sometimes went a bit higher, sometimes a bit lower, but that was the typical yield on this particular security. And I think it's reasonable to say that a 3% real return on government bonds is a sensible long-run expectation. You'll notice at the end there that the yield on consoles soared and then collapsed again. That sharp increase in yields was the result of inflation. At the end of the Second World War, people expected the price level to remain stable, and the yield on consoles was a bit under 3%. And then it soared, as you can see, up to a figure of over 16% in the mid-1970s. Now, the price of the value of an undated government bond of this sort varies inversely with the yield. If there's £100 nominal in issue and there's a 3% coupon, and the 3% is the going yield on government bonds, then the security is worth 100. If the yield is 6%, most bonds yielding 6%, then the yield on consoles has to match that, so the price falls to £50. If yields move up to 12%, then again the yield on consoles has to match that, only paying 3% per 100. So the price has to fall to £25. So the price and the yield vary inversely, and it's obviously possible that the price of the undated console can actually fall beneath the yield. What happened in the 30 years to the mid-1970s was that the value, investors in government bonds were hit by what you might call a double whammy. First of all, inflation went up, the yield on government bonds rose, the rise in the yield on government bonds reduced the nominal market value in the way I've just explained, and then on top of that, the real value of the bond was reduced by inflation. The nominal value fell, and the value of the pound went down as well, so there were two hits to the value of the investment as far as the investor was concerned. Inflation in Britain reached an all-time peak in peacetime of 26.9% in August 1975. This followed 20, 30 years of financial irresponsibility with large budget deficits and accelerating money growth. In the early 1970s, there had been money growth of over 25% a year for 2 years on the trot, and that was the background to that 26.9% inflation rate. Let's just then think about, so what we had in 1974, the third quarter of 1974 in fact, we had the yield on consoles up at 16.8%, and the price was about £15. So you actually had this situation in which the price was less than the yield. I myself was active as a journalist in this period, and then I moved to work in the City of London as an analyst of the government bond market, where I became very interested in the relationship between money and inflation. And my career started in the city in 1976. So what I'm going to do in the next few minutes is just show you what happened to the real value of an investment in consols and other government securities in this 30 years to 1976. First of all, we've got this chart showing the value of the nominal value of consols in the market. Went down, taken 100, 1946 as the base. It had fallen to, I think it's, what is this, about 80, it had dropped to about 85% in nominal terms between 1946 and 1976. But on top of that, there was a fall in the value of the pound because of inflation, because of the rise in the price level. And overall, if you put these two factors together, the fall in the real value of consols in that of a typical undated British government bond in that period was 97%. In the late 1940s and early 1950s, many bank managers and solicitors advised their middle-class family clients to buy government bonds for their safety. After all, in the interwar period, prices had gone down, so this was a safe investment. The government would always pay back, and what happened in that 30 years to 1976 was that the real value of an investment in British government debt fell by 97%. Now, after this sort of looting of the Rentier, as I call it, it's not surprising that any future investors in British government bonds had to be paid a higher real yield. And there are various responses in the British public policy making to what had happened in that 30-year period. One, of course, was the introduction of monetary targets, and then from the early 1990s, inflation targets. But also in 1981, we had the first issue of index-linked government bonds, nominal value linked to the retail price index, therefore giving inflation proofing to the value of an investment in government debt. At that time, the typical real yield on a conventional gilt, consols, 10-year gilt, 30-year gilt, and so on, would typically be about 5%, a real yield on conventionals, 5%, because people had to be persuaded to hold government debt after what had happened in the previous generation. So you had typically 5% inflation, 5% real yield, a 10% yield on government bonds. And this chart shows you the real yield on those index-linked gilts in the early years. And you can see that it's typically around about 4%, sometimes even 5%. It's understandable. Just be clear, there had been this appalling theft, in effect, from the investors, middle-class investors in government bonds up to the mid-1970s, so there had to be a decent return after that. Well, now we come to Alice-in-Wonderland. That chart finished in the late 1990s. We're now in 2020, and you can see that there is a negative yield on index-linked UK government bonds of over 2%. In other words, if you buy an inflation-proofed British government bond, then you're going to get back less in real terms when the bond is redeemed than today, and the rate of loss will be about 2.5%, sometimes 3% a year. Why on earth is anyone investing in this paper? Part of it, I suspect, is regulation, that some pension funds are simply forced to hold index-linked gilts in order to match their liabilities that are fixed in real terms. And this has led to an anomalous situation in which index-linked gilt yields are negative by quite a significant amount. Of course, we have an inflation target regime, which is supposed to deliver 2% inflation in the medium and long run, and has indeed done so for some time. So the typical yield on conventional gilts is under 0.5% for 10-year gilts and under 1% for 30-year gilts. The undated part of the market has really disappeared now. Well, these kind of yields are even lower than in 1946 after the Second World War. And I just explained to you what happened to gilt-edge investors in that 30 years that followed the immediate post-war period. One has to worry because the British public debt is rising rapidly because of the coronavirus and the widening of the budget deficit, and also, may I say, because the current government plans to spend more on such things as HS2, the train line to the north of England, and has made a number of announcements in recent weeks which have a significant future cost. At any rate, the net public debt has gone above GDP for the first time since 1960. And just to quote from the press release on public sector finances from the Office for National Statistics, public sector net debt, excluding public sector banks, rose by £276.3 billion in the first 7 months of the financial year. It's expected to go up by £400 billion for the year as a whole. And this is reaching £2,076.8 billion at the end of October, around 100.8% of GDP. Highest levels since the early 1960s. If we were to get back to the kind of 10% yields on government debt seen in the 1970s and 1980s, even more than 10% at some points. I just told you that we went up at the peak to about 16, 17%. Then plainly, if the debt were equal to 100, 110% of GDP or rising even further, then the interest on the debt, just the interest on the debt, would itself be heading towards 15, 20% of GDP. We would be in an appalling public debt crisis. But that's not the situation. The point is that the actual yield on index-linked gilts is negative by 2%, and on 30-year gilts it's just 1%. So here is the chart of the ratio of public interest, the debt interest payments on the public debt debt interest payments relative to GDP, going back to Napoleonic Wars. That time, just after 1815, Battle of Waterloo, it was actually up towards 10%, went up to 10% again almost in the 1920s after the First World War, a smaller peak after the Second World War, another peak in the 1980s reflecting those high interest rates at that time, and now nowhere near there. In fact, in the last few quarters, last few years, indeed, the ratio of debt interest to GDP has gone down, reflecting this very low level of interest rates that I've been talking about, this amazing Alice-in-Wonderland situation that we currently have. That's even gone on into 2020 with this surge in debt, because most observers are expecting low inflation, possibly deflation, in the years to follow COVID-19. I don't expect that, but that's what many people do expect. And so the very latest value of the debt interest to GDP ratio is lower than it was in 2019. I think just to finish here, a point I'm trying to get over here is that we are in an amazing situation where the debt is exploding, and we've had an example in living memory of holders of British government bonds being defrauded on a massive scale by inflation. And yet we've still got these very low Alice-in-Wonderland government bond yields. While that's the case, UK public debt and its financing and its servicing is easy enough. But what happens if inflation does take off? I'm suggesting inflation's going up to 5% or so in the next year or two, maybe it's 2023, I don't know, but the kind of money growth numbers we're currently seeing, inflation will rise. If that then implies a rise in government bond yields, then there is a very serious public debt crisis out there in the medium-term horizon. Thank you.